Hi everyone, it's Ben Adams with the American Offset Mortgage, and welcome back once again to the channel. Now today, what we're gonna chat about is not only student loans, we're gonna continue our conversation there, but we're gonna talk about the student loan repayment features, specifically the income-based repayment feature. And it's something that's really, really important. It's very misunderstood, and it's something that, if not managed and handled correctly, can have disastrous consequences on a student's or someone's financial livelihood. But before we get into that, please give us a like and subscribe. Again, this American Offset Mortgage channel, we're here to educate. It is a channel that focuses on financial literacy. We want to help educate you, not just with your finances, but also your budgeting, your credit. We want to talk about things that are very important that impact millions of Americans, like student loans, like mortgages, like building wealth. So give us a like and subscribe. Now, one of the big concerns with student loans is once the student graduates from school, we've talked about the cost of education, we've talked about the possible pitfalls and the concerns when the student is 18 or 19 taking out that student loan debt. But something that isn't talked about enough is the repayment characteristics with student loans and how that works, because it is a lot of times not as straightforward as one would think. And when you're talking about someone in their early 20s who doesn't have a lot of life experience and doesn't know how this stuff works, it can be very confusing, and it has to be understood because it is that important. Now, a lot of student loans allow for what's referred to as income-based repayment. Now, this sounds friendly and this sounds like a great thing. And what it means is that the payment for the individual student loan is based off of how much they make. And so for someone that is earning less after they graduate, their monthly payment is going to be less than someone who is making more. So for someone who's making $30,000 or $40,000 a year, their payment on their student loan, if it has this feature, is going to be based off of their salary or what their prospective salary is going to be. So if they're making $30,000 to $40,000, well, it's going to be less than what the person who's making $80,000 or $90,000 is going to be. So it sounds nice, it sounds friendly, but here's the thing: it is not. It is extremely toxic. An income-based repayment for student loans is one of the most toxic loan features when it comes to student loans and how they work. So here's what is a lot of times not understood. Someone who has a student loan and they are on an income-based repayment, if their minimum payment based off of the amount of student loan debt, let's say that the individual has $60,000 in student loan, and based off of the interest rate, let's just say that payment is supposed to be around $500 a month. Well, if someone is earning $30,000 or $40,000 and they're on an income-based repayment, they may only be required to make a payment of $200 or $300 a month instead of the $500 a month. So that sounds great, doesn't it? You're supposed to be making a payment of $500 a month, and you're only required to make it a payment of $200 or $300 a month. Well, here's the deal. If you're making a payment, and this is what is not always communicated well, and this is what a lot of times the student doesn't understand with this specific feature, is that if they're supposed to be making a payment of $500 and they're allowed or they're told they only need to make a payment of $200, well, what happens to that $300 there? Can you guess? That $300 is then tacked back onto their loan. So if they owe $60,000 after month one of an income-based repayment, if there's a $300 deficiency, they now owe $60,300. And guess what? The interest now that's being charged is now based off of the $60,300, not just the $60,000. And so fast forward 5 years, 10 years later, I look at credit reports all day. I work with students, I work with home buyers, and I get to see a lot of this information. I've seen customers start off with a student loan of $50,000 only for it to balloon to $75,000 or $100,000. I've seen student loans start off as low as $50,000 and end up and increase over $200,000. And it's because of this toxic income-based repayment. Now, here's the deal. In the mortgage world, back in 2008, when we had the great housing crash and the Great Recession, you saw a lot of types of these mortgages, and they were considered toxic, and they were also considered, not just subprime, but one of the big reasons for the housing crash, because borrowers did not have the ability to repay this type of debt. They didn't understand how these negative amortization loans worked, but we're allowing the same thing with students. We are allowing the same type of financing in the student loan world. And the same things are happening. These students have no idea how this debt works, and they don't have any idea how the repayment works. And another thing that's not talked about enough is the opportunity costs. Instead of taking out a large amount of student loan debt and going to a 4-year school to get a 4-year degree, what are other options that a prospective student, instead of getting a higher education, can go do? And so again, I'm not telling someone that going to college or taking out student loan debt is right or wrong. I believe that it's a very personal decision. I believe that the student needs to make that decision for themselves. I also believe that there is too much pressure from society, from family, from parents, grandparents, from other well-intended family members that are a lot of times misguiding or misleading students. And I want to make sure that students are understanding all of the pros and all of the benefits when it comes to student loans and repayments. Now, here's the facts. The facts are, if you go to college and you have a college degree, the data and the statistics say that you still are going to out-earn someone who does not go to college. So you will make more, or historically you have made more when you have a college degree than someone who does not. But now in 2023, we've touched on this on some of our other videos, the cost of education has increased 8 times faster than the median wage over the last 30 years. That is alarming. And not only that, there is a lot of student loan regret happening. And I'm always reading articles, I'm always educating myself on not just student loans, but everything finance related. Let me share some statistics with you. Did you know that a new survey found that over 63% of college students regret their student loans? Nearly half of those same students have been paying on their student loans for over 10 years. 22% of those same students say that student loan debt has adversely impacted their mental health. And 28% of that survey says that their student loan debt has been a barrier to owning a home. 72% of the survey found that people that finance their degree regret their decision and the amount of student loan debt that they took out. And 24% wish they had taken a different degree so they could have a different career. And around 20% of the survey found that they wish they had gone to some type of lower cost higher education first, like a community college, before going to a traditional school, because the cost of education have increased so much. And a lot of this is because, it's not just about the cost of the education, it's the fact that these students, when they took out the student loan debt, they didn't know how the repayment worked. And here they are 10, 15, 20 years later, they're still making payments on this debt that they had no idea was going to be lingering around for that long. And this last statistic is really important because around 50% of that same survey is now advocating and wish they had understood financial literacy a lot better so they could understand the pros and the cons. And one of the big things is, again, if you're on a negative amortization loan or an income-based repayment loan, we've always talked about compound interest, in terms of the stock market or how you can use compound interest to grow your wealth. Well, there's a flip side of that. If you have a student loan or a negative amortization loan that allows for income-based repayment and the loan balance is getting higher every month, and as a result, the interest that's being charged is going up and up and up, that can be disastrous and have incredible, terrible consequences. So nearly half of the survey wishes that they had better and higher financial literacy at the time when they took out the student loans. Thank you once again for tuning in. This is Ben Adams with the American Offset Mortgage. Goodbye.